SanDisk just posted sequential revenue growth of 97%. And wait, that is in physical hardware, not software.
Right, along with a 78.4% gross margin. They are basically wearing a software costume at this point.
They really are. Welcome to Earnings Unscripted, everyone. Today is April 30th, 2026, and we're unpacking SanDisk, ticker SNDK, and their absolutely wild Q3 results. And just a quick legal housekeeping thing, since Miro usually loves to tear apart a bad thesis. This is all just our personal opinion and definitely not financial advice.
I actually don't have a bad thesis to tear into today. It is impressively clean. But looking at the core figures, the top line hit $5.95 billion, which is, roughly a double from Q2. And EPS came in at 23.03. So the headline growth is staggering.
Okay, but if it is so staggering, what is up with the tape? Because the stock opened huge this morning, but then the second the extended session started, it just fell off a cliff. I think it closed down about 3% against yesterday's close.
Yeah, it is a classic case of expectations being entirely decoupled from reality. The stock was up almost 150% going into the print over the last quarter. So anything short of a total miracle triggers a sell-off. And they gave us a miracle in the Datacenter, sure. That segment grew 233% sequentially.
Wow. Is that just from AI scaling?
Exactly. Large language models need to store massive amounts of intermediate data, things like KV cache and retrieval-augmented generation. It requires incredibly fast memory. But actually, here's the friction point. The consumer side fell 10%. So it's a very lopsided quarter.
Okay, so regular people are not upgrading their laptops, but enterprise customers are panic buying infrastructure, which actually explains the craziest part of this report. They're basically forcing customers to lock into multi-year contracts to guarantee supply.
They are, and it completely reshapes how they model revenue. They started quoting RPO, remaining performance obligations. They have $42 billion locked up in future backlog right now. You just do not see that kind of SaaS metric in cyclical memory hardware.
Right. Let's get into the details on that. Because turning hardware into a 5-year subscription model is a huge shift.
It is a complete departure from the historical memory market. Usually, NAND chips are just this brutal cycle of overbuilding, prices crashing, and companies bleeding cash. But SanDisk is now securing these 5-year agreements with firm financial backing.
Right, and they have to, because if you are SanDisk, you cannot scale up multi-billion-dollar fabs just hoping the AI craze holds up next year.
Exactly. So they are demanding and getting massive collateral. They actually required over $11 billion in financial guarantees sitting in third-party banks to protect these contracts. They already have $400 million of that sitting on the balance sheet as prepayments.
$11 billion in hostage money. That is just wild.
It is. And the CEO, David, was surprisingly blunt about it on the call. He said, and I am quoting here, "We have customers that are literally putting up billions of dollars of collateral, and I actually probably never expect to collect those because I think our customers are extremely serious about needing this product."
Okay, but if customers are willing to tie up billions of dollars in a bank account just for the privilege of buying storage, the supply panic must be very real on their end.
Oh, it is real. Which actually leads to probably the most unusual detail in this whole report. Despite this crazy revenue spike, their core BY6 memory shipments actually fell in the third quarter. They were down in the high teens sequentially.
Wait, revenue basically doubled, but their actual shipping volume dropped? Is that just pure pricing power doing the work?
Pricing power did a lot, yes. The average selling prices outpaced cost, but the volume drop was a deliberate choice. They intentionally built up inventory instead of selling it.
To hoard it for the new business models.
Yes, and to prepare for this massive ramp-up of their new QLC architecture next quarter. They call it Stargate. They are basically starving the spot market right now to ensure they can feed these new 5-year enterprise contracts.
Okay, I see the logic. It is just such a massive pivot from the old strategy of just clearing inventory as fast as possible. But there is a catch here, right? Because to deliver these Stargate drives, they need other components. I thought they were just a pure NAND company.
They are. But building out these advanced storage arrays requires memory controllers, and those controllers require DRAM to function. SanDisk does not make DRAM. So they quietly dropped a $1 billion investment this quarter into a third-party DRAM provider, a company called AMIA.
Just to guarantee they have the complementary pieces. Geez.
Right, because if you are on the hook for $42 billion of committed backlog, you cannot let a completely different memory component bottleneck your entire delivery schedule.
Right, a missing $20 chip stopping a $50,000 array from shipping. We saw a lot of that in the pandemic. So this whole quarter is really just them de-risking their entire future.
Exactly. And the financial fallout of that de-risking is incredible. They just fully paid off their remaining term loan. So less than a year after spinning off from Western Digital, they are sitting on a zero-debt balance sheet.
They actually paid a penalty to do that, did they not?
Yeah, a $46 million write-off just for unamortized fees to extinguish the debt early. But they don't care. They cleared the slate so they could immediately authorize a new $6 billion share repurchase program.
Because why sit on cash when your revenue is practically a locked subscription at this point?
Exactly.
Okay, so if the balance sheet is pristine, the supply is essentially spoken for, and pricing is structurally higher, where does that actually leave them heading into next quarter?
It leaves them staring down some frankly absurd guidance. Management is modeling Q4 revenue somewhere between $7.75 and $8.25 billion.
Wait, so that is, what, another $2 billion step up sequentially?
Pretty much, and non-GAAP EPS jumping to the $30 to $33 range. Margins probably hugging 80%. But the execution window here is tight. A lot of this rides on that new Stargate QLC product launching for revenue next quarter.
Right, the higher density storage. But does that not run the risk of just cannibalizing the TLC drives that literally drove this entire data center beat?
Exactly. You pivot the enterprise customers to QLC too aggressively, and you might accidentally hollow out your own current profit engine. And then there is the bigger cyclical unknown with these new multi-year contracts.
Ooh, because we do not actually know the fine print.
Yeah. The CFO admitted on the call they cannot go into detail, but there are both fixed and variable pricing components in that $42 billion backlog. So if the broader AI memory market suddenly oversupplies in 18 months and spot prices crash, what happens to that variable floor?
Right, because corporate guarantees are ironclad right up until the exact moment they become financially inconvenient for the buyer.
Mm-hmm. The customers will absolutely push back if prices drop. I mean, you can never completely kill the hardware cycle. It is just entropy with better marketing. Though, to give them credit, this is the most elegant defense against cyclicality I have ever seen in semiconductors.
It really is a fascinating pivot. They essentially built a fortress. We just have to see if the walls hold when the macro weather turns. All right, I think we can wrap it there. Thank you so much for joining us on Earnings Unscripted, everyone. We'll catch you after the next print.
Take care.
By the way, if you want these earnings teardowns to just quietly show up in your feed, the easiest way is to just follow the show. And just a quick transparency note, this entire podcast is brought to life using AI tools, which is honestly the only way we can synthesize a dense corporate filing into a natural conversation so quickly. We would really love to hear your thoughts or any company requests, so just shoot an email to earningsunscripted@datamadness.ca or grab our X link in the show notes.
See you next time.